Imagine if you could look at a company's cash flow statement and be able to tell if trouble was on the horizon. Believe it or not, but you can do just that in a few seconds once you learn how to spot cash flow statement red flags. In this video, I'll explain the 3 biggest cash flow statement red flags, what they mean, and how to spot them quickly. Hi, my name is Brian Feraldi. I'm a financial educator who's been analyzing and investing in individual businesses for more than 20 years. Cash flow statement red flag number 1 is excessive stock-based compensation. When you look at a cash flow statement, you can look at the company's actual spending on stock-based compensation under its non-cash charges. If the company is issuing an excessive amount of stock-based compensation, that means that the management team is heavily diluting shareholders. Now, the formula to figure this out is take the total spending on stock-based compensation and divide that by revenue. As a rough rule of thumb, this number should be well under 30% of total revenue for a very high growth company, growing over 30% per year, and well under 10% of revenue for a low growth company, so growing less than 10% per year. Now, to show you how to figure this out quickly, I'm going to go with a FinChat and pull up Snowflake as an example. So if I scroll down and click on total revenue, there's the company's total revenue. Then if I click to the cash flow statement and click down to stock-based compensation, I can now chart these two numbers together. So in January of 2024, the company had $2.8 billion in revenue and about $1.1 billion in total stock-based compensation. That is well over 30% of the company's revenue. So even though Snowflake is growing extremely quickly, that is certainly a cash flow statement red flag. That brings us to cash flow statement red flag number 2, when the company's operating cash flow is less than its net income. When you see this happening, that indicates that the company has very low quality earnings. As a general rule, operating cash flow should always be bigger than net income. Here's how you can easily check for this red flag using FinChat, and I'm going to show you how to do so using GameStop as an example. I scroll down to the cash flow statement, click on net income, and then I'm going to track that against cash from operations, aka operating cash flow. As a general rule, we want the blue number here, cash from operations, to be bigger than the green number. As you can see, in the last couple of years, the company's cash flow from operations has been less than its reported net income. When you see this happening, the most likely culprit is that changes in the company's working capital, aka payables, inventory, and receivables, are all trending in the wrong direction. And they have to be doing so at a pretty rapid pace for those changes in working capital to overwhelm the company's non-cash charges. So when you see that cash flow from operations is lower than net income, that is a cash flow red flag. And that brings us to our third and final cash flow statement red flag, a big divergence between a company's net income and free cash flow. Now, you can find this by looking at the company's net income and then looking at its free cash flow, which is simply operating cash flow minus capital expenditures. As a general rule, these two numbers should roughly match each other over time. If you see a wide divergence between net income and free cash flow, that is a big red flag for investors. Here's how you find this information quickly in FinChat using Netflix as an example. I'm going to scroll down to the cash flow statement, and then I'm going to pull up the company's net income to see the company's net income, and then I'm going to go over to free cash flow and click on free cash flow. Now, as a general rule, you want to see these two numbers generally matching each other. And as we can see, over the last 10 years, there has been a huge disparity between the company's net income, which has been positive, and free cash flow, which in some cases has been hugely negative. Now, in Netflix's case, this just simply means the company is prepaying for a bunch of content and funding the production of new content, which is producing a cash outflow. However, when we think about Netflix's quality of earnings over the last 10 years, it has been very poor because the company's growing net income has not been backed up by growing free cash flow. And on that judgment, that is certainly a huge red flag for investors to be aware of. Now, just because a company trips one of these red flags, especially if they do so on a temporary basis, doesn't mean it's not worthy of investment. But if you see any of these red flags being tripped, that just means it's on you, the investor, to find out more information about why this is happening and whether it's a big deal or not. Now, as I hope I've shown, it's critical for all investors to be able to understand how to find, read, and interpret a cash flow statement, especially when cash flow statements are not standardized and there's a whole bunch of different terms you may see on a cash flow statement that change from company to company. To make things easy to understand, I created a free ebook that has all 3 major financial statements along with the synonyms that you might see presented from each individual company. If you want a free copy of this ebook, simply visit longtermmindset.co/FSS ebook or click the link in the video description. Well, I hope that you enjoyed this video. If so, give it the thumbs up and let me know in the comment section what other videos you'd like me to make. If you want to keep on learning, there's a 100% chance you'll enjoy this video next.